Good day, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for WealthPress. Today is Monday. It is August the 16th, and as you can see here, the markets are down a little bit more than random. Matter of fact, the Dow's down about 100 points, and Nasdaq is down 48 points. Pretty significant. S&P mini, nothing really that's significant, but the bottom line is the Dow is down more than 100 points. Anything below 85 or above 85 is beyond random. We've got a lot to talk about this week. We've got retail sales tomorrow. That's a big indication of how the FOMC and the GDP is going to do. We've got the housing market index. We've got industrial production tomorrow. We've got FOMC minutes from the Fed with Jerome Powell speaking tomorrow. And then we've got the Philadelphia Manufacturing Index and jobless claims. Lots of reports. The big one that I'm looking for is retail sales. That's going to impact a lot on the consumer discretionary account and housing starts. Housing starts, retail sales, and obviously the manufacturing activity. And we always want to see what Powell will project or what he will think happens in the next 10 years. God knows this guy, he loves to make predictions. He loves to make predictions and then he changes his mind. We're not going to take any action till the end of 2023. Oh, wait, we may reduce the bond buying as early as this summer. I mean, don't get me started with Powell. But the bottom line is what you need to pay attention to is the bond market. I think the bond market is going to continue huffing and puffing and trying to pretend like it's going to make its way above the 200-day moving average. But look, the bottom line is, folks, interest rates are going higher. They're not going lower. The Fed is not going to sustain its bond buying program for another 2 years. Interest rates are going to go higher, which means the bond market will more than likely huff and puff and then break through the 200-day moving average as I've been expecting it to. Notice we've had 3 lower highs. That's not a very bullish sign. So unless we break above the 151 level, which I doubt we will, because the long bond is expecting higher interest rates. Now, as far as the stock market, we are grossly overbought. As you could see here, the RSI is just crazy overbought. I mean, this thing is just nuts. And again, if you look at the mid caps, which we will look at right now, which is probably the best representation of the stock market, you will see here we're still rather choppy. Not a lot of directional bias. Those large cap stocks are still overvaluating or putting a shadow on the smaller stocks. Looking at the volatility index, we are now, as you could see here, right at the pre-COVID levels. Now, volatility is mean reverting, and based on what I'm seeing right now, I have a fairly good sense that we're going to start seeing a spike in volatility, which would put a damper on the stock market and would cause stocks to go a little bit lower. And also, consider the fact that interest rates going higher, which means bonds going lower, is fairly bearish for the stock market, especially techs and those type of stocks. Now, looking at the stock market major indices, and it is a Monday, so I do want to take a look at the major indices. Financials look like they need to cool off a little bit, maybe for a few days before going higher again. Energy sector is going to maintain its choppy bias, not really seeing anything there. Utilities are overdone. I think the defensiveness of this market, I know that COVID has been running amok, but I think the utility sector is going to cool off and enter a choppy period. Industrial, I think, are also going to be kind of choppy, maybe a little bit higher, not too much. And remember, folks, we're entering the 3rd week of August. So the word choppiness and 3rd week of August are fairly synonymous with one another. The consumer staples, as the utilities, these two move hand in hand. They are both overbought to the upside. I would be very cautious with consumer staples, at least for the time being. I like the healthcare sector. I actually like it quite a bit, and I like the real estate sector. I think out of all the sectors so far that we've looked at, the sectors that have the best opportunity for directional movement as of right now, at least for the next few days, is the healthcare sector and the real estate sector. I think those two are looking really good. I like the choppiness of these sectors, and I think there's a good chance they can break out. I especially like the real estate sector, and I also like the healthcare sector. Basic materials looks like it can go a little higher. Notice that industrial and basic material are kind of doing the same thing, which is how it should be. Consumer discretionary is choppy. The retail sales report right here is going to have a big or should have a pretty big impact on it. But I like technology. Here's where I'm at right now. I like technology. I'm kind of neutral on the communication sector, but I don't like the consumer discretionary. Now, typically, usually, 90% of the time, there's a very strong relationship between technology and consumer discretionary. But I'm liking the tech stocks, like the hardware stocks that don't really have any type of consumer sexiness to them. Like, for example, Microsoft and Apple. Those are about 50-50 consumer, Amazon, 50-50 consumer discretionary, 50-50 tech. I'm talking about hardcore tech, like semiconductors I like right now. I like stocks that don't really sell anything directly to the consumers, that are more grounded in the second, third, like hardware, software. Think not hardware for computers, not hardware for people. Does that make sense? So deep tech, hard tech that doesn't benefit consumers directly, but benefits other tech that then benefits consumers, if that makes some degree of sense to you. So I do like technology, but hard tech, not consumer discretionary tech. I like healthcare and I like real estate. So I do like healthcare, I like real estate, I like technology. I like the way they're chopping up and going a little bit higher, where the rest of the sectors, I still think we'll get a little more upside from basic materials, and I think we'll get a little bit more love from industrial. But utilities, consumer staples, financial, energy, I think they're going to be kind of choppy for the time being. Now, let's talk about the global economy a little bit. Global shares slipped Monday and worries over COVID in Asia, as well as the long-term impact from Afghanistan government collapsing. Geez Louise, that can cause some volatility as well. And I know it's summer, but global events like that could cause volatility. Analysts say relatively low vaccination rollouts in Asia are pushing down investor sentiment. Not good, because remember, Asia exports to this country big time, second biggest economy. Japan, Thailand, Malaysia are among nations that have recently reported record numbers of new daily cases. Vaccination rollouts in many countries have been unsteady or outpaced by virus surges. In Japan, the government reported that the economy grew at an annual rate of 1.3%, raising hopes for a gradual recovery. It's better than expected from the damages brought by the pandemic. Some analysts had expected a contraction, including myself. Underlying growth was improved by private consumption and residential investment, as well as rising exports and imports. Now, I don't really care about too much about imports to Japan, but I do care about exports. Cars, remember folks, Japan, cars, hello, Honda, Toyota. Also pushing down investor optimism was the University of Michigan Consumer Sentiment Index, which fell to 70.2% from its previous level of 81%. That was the largest drop in sentiment since April of 2020, when the pandemic took its initial grip on the country. Now, this is really, really important. Why? Because look at volatility. Volatility is at the lowest level since before COVID, and volatility is mean reverting. So there is a chance right now that we may, if COVID complicates our lives, there's a good chance we may see some downside, because sentiment is changing. If we find out that retail sales tomorrow are bad or really, really weak, that's going to really, really drive down sentiment. And when I say sentiment, I mean consumer sentiment, consumer discretionary, not consumer staples, consumer discretionary. So keep your eye on consumer discretionary in light of the retail sales tomorrow. That's going to be big, big, big. And you want to watch industrial production and the Fed manufacturing index as well, because that's going to impact basic materials and that's going to impact industrial. Now, if industrial can get above the 106 level, I think we can see a nice breakout. And if basic material can get above the 89 level, I think we could see a nice juicy breakout. Now, in terms of the stock that I like, the only stock that I'm liking right now, and markets are very choppy, very flat, and I'm actually going to talk about some bearish trades later today, but CBRE. This is a real estate company, a global real estate company. They have real estate markets all over the world. Multifamily. You see multifamily? I think multifamily is going to be huge, 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 huge. They do all types of real estate, but right now, multifamily is where the market is. They're up 100% over the last year. Their earnings per share growth versus previous years, 288%. I like the stock quite a bit. So very, very important. I think we may come down a little bit more, fill this gap to the 91 level, and then I think we're going to be rocking and rolling again. Now, I know it's Monday. Pay attention to me this week. We've got a lot of news, a lot of market moving news, a lot of volatility, and potentially a reversion back to volatile levels. Because, folks, sentiment is changing. Sentiment is declining. And sentiment is what drives consumers. And consumers is what drives 2/3 of our GDP. But, folks, I've got something important for you, something timely, something you need to pay close attention to. The current market environment has made it harder than ever to pick promising stocks. Large caps, inflation, interest rates, potential government restrictions are all pulling the market in different directions. Great Caesar's ghost. You guys got to be on top of this. There's a lot of stuff going on. So hot stocks aren't as easy to find as last summer. Remember last summer where all the COVID stocks were going nuts? It's not that easy. Remember Zoom last summer, Peloton? Holy moly. The old buy and hold strategy may not be the best approach right now. Not even close. I mean, Warren Buffett is struggling right now. Folks, investors need a more systematic system, a more systematic approach, a way to find out what levels get you in and out of stocks and what their profits target should be. That's what you need right now. This type of analysis, not buy and hold. Well, folks, I've got a strategy that does just that. And it accomplishes this by using what I call the sniper line. That's right, the sniper line. Now, we were able to make a 94.1% gain on WWW just this past week, while the markets are doing nothing. Want to learn how investors can approach the market systematically in today's uncertain markets? Click on the link below and learn more about my Sniper Trader Pro service. Do it now. Do it before we take it offline. This is a great way to trade during quiet market periods. And when volatility rises, man, this system thrives in volatility. Folks, follow the link below. Learn what investors have known all along. The sniper line is your way to sustainable profits in the long term. At least that's what we've been seeing for the last 7 years. I think the average return is like every 16 days, 56%. It's doing really well. Check it out now. Learn more about my Sniper Trader Pro service. Do it now. And make sure to like this video. Subscribe to this channel if you're watching on YouTube. Stay ahead of the market by being the first to be notified when I post my next video for you. And have a great, great week ahead. Bye, guys.